Hello everyone, thank you for joining us on this webinar today. I'm Divya Menon, Head Products at Axis AMC, and with me I have Mr. Shreyash Devalkar, who heads Equity at our AMC. Today's topic for this webinar is on the Axis Large Cap Fund. And I won't take much time and simply dive into the questions for you, Shreyash. Now, I would want to address the elephant in the room and get the most toughest question out, which is on the underperformance of Axis Large Cap Fund. So Axis as an AMC is known for its quality and growth oriented philosophy. Axis Large Cap Fund is one of its flagship funds and follows a similar strategy. But the last couple of years have been tough for the fund. If you could, pinpoint at the reasons that has been dragging the performance, I think that is what people want to know.
Sure. Actually, if you notice the Axis Large Cap Fund's performance, the 2 years or couple of years post COVID, the rally which started post COVID, that has been actually the toughest year for this fund in terms of performance. The couple of reasons has been there at that point in time. It was mainly because of our orientation of this fund has been always towards the consumption oriented or B2C oriented companies, which included both the retail credit growth driven bank NBFCs and retail companies and so on. So multiple such companies.
Multiple sectors in the consumption space.
Yes. And that benefited us definitely in the pre-COVID times. While post that point in time, because of supply constraint which got created because of lockdowns and multiple point in time after that geopolitical tensions, suddenly there has been a sharp re-rating in the other part of the market, which is a B2B or what is wherein the companies in the manufacturing sector and so on. So that because our orientation was totally on the other side, and that's where and with the sharp rally, initially there was sharper underperformance during those couple of years.
The 2 years, say post COVID times.
Yes. And post that we have taken multiple corrective action in the fund. So you must have observed that the fund also tilted. We changed multiple top holdings. We tilted to the B2B side of the businesses as well, and we diversified the portfolio during after that. After that, if you see, then the mid and small cap rally started, and in this fund we have always kept a large cap oriented fund. If you see, even now the mid and small cap exposure is next to negligible, so we continue to own large cap in this. So that's where the initial part and subsequently, if you see the subsequent underperformances were not as high as the initial part.
Yes, but the balancing act that you took from say the 2 years post COVID to the next 2 years.
Yes.
Unfortunately, it coincided with a significant rally in mid and small cap, and for you, the way you manage Axis Large Cap Fund would be more conservative or more focused on the large cap area, right?
It's the fund we always manage with the large cap orientation, and that more exposure to mid and small cap might have helped with fund performance. But in my judgment, that part of with the currently whatever rally we have seen in the mid and small cap over last 2 years, more so over of last 2 to 3 years actually, not only 2 years actually. It's a 3 year basis. If you see the 3 year rolling return of mid and small cap is 20% CAGR, while large cap is about early teens. So it's not there is a huge difference. So to that extent, there is a difference which has crept in. But because of this outperformance and the relatively higher valuations, we think that the large cap space has a better risk reward today, especially when the crude oil prices are coming down. So we continue to remain with the large cap even now.
So, now that the passive space is growing and investors today are also looking at passive segment, which was not the story a decade ago. But today an investor has a passive option against an active option. For this space, the large cap category specifically, how do you view the debate between active and passive?
So debate of active versus passive has been there both in the developed world as well as in our market as well. And if you look at, especially if you are talking about the large cap category, yes, the category returns versus the large cap index returns, there has been the returns were in favor in case of passive strategies. In my opinion, as an investor, one should invest across all the strategies. So to me, a passive is a strategy wherein you invest in the index. The value is also a strategy, growth is also a strategy, quant based models are also a strategy, and factor based models are also a strategy. So there are multiple strategies which are available. So in my opinion, one should invest in based on your appetite in the strategies whichever you are comfortable with. Having said that, in the large cap space, if you notice at our end also, so there are 100 stocks in say BSE 100, which is the underlying benchmark for the fund, while in our fund there are 47 stocks. So you are taking active bets in there. Obviously, if the bets play out the way you have thought through, what is your thesis behind all those positions which you have, if it plays out well, then definitely it has a potential to deliver good return. So there is a probability of returns in the active strategy. So that way I would actually say that yes, active funds also need to be part of the
essentially
portfolio.
both of them can find space in in an investor's portfolio. You brought out the point on stocks. An index is bound to say 100 stocks, while you can actively maneuver your strategy. So has there been a point in time where you were diversified, or where you are now moving to concentrated portfolio? Has in the last couple of years things changed for you in terms of portfolio holdings?
Yes, definitely. The versus last year, same time the holdings were closer to 54, 55, and now from there we have already concentrated, because what we thought is that the number of companies which are doing better now, they have reduced versus their respective valuations, and accordingly we have concentrated also in this portfolio, and that's what is the opportunity with the active fund management.
So somewhere you can say that if you want to play conviction, then that play can come through an active portfolio rather than a passive portfolio. And on similar lines, you could also say that if you want to take calls on say sectors, benchmark indices would be skewed towards couple of sectors, and other sectors would have lighter weights, while in active funds you can see that playing out very differently, right?
True. So if you look at our funds now, they are overweight on the lending, they are overweight on pharmaceutical as such. So there are multiple segments where you are overweight, sizably overweight actually, and there are a couple of sectors like commodities where we are actually underweights are very high. So that kind of differentiation one can have in a actively managed strategy.
Correct. So it could also happen that you can take a call of going, not taking exposure to that sector at all, or taking very minimal exposure to those sectors. So that just cannot happen in a benchmark fund. That's a valid observation. So moving on to a part where, from an investor's perspective, why do you think a large cap category, and then specifically, Axis large cap fund, why do you think one should invest? The reasons for looking at large cap category, reasons for looking at your fund specifically at this current juncture.
Sure, true. That question is very valid, because in last 3 years to 5 years, the large cap category has underperformed to mid and small cap categories. The reasons, as I highlighted in the initial part, the part of the reason lies with the large cap indices are more geared towards financials and B2C space, while in mid and small cap indices are more geared towards manufacturing and B2B spaces, what we call. So these are the reasons where this post COVID rally which happened in the market, there is the mid and small cap outperformed. Now, with this outperformance, if you just start looking at the large cap valuations, the large cap valuations are now closer to or marginally above the pre-COVID levels. So if you take the sectors like lenders, if you take sectors FMCG, IT again, but IT has its own troubles obviously, auto OEMs, so oil and gas. So there are multiple sectors in the large cap where the valuations are reasonable if you compare their valuations compared to pre-COVID. Now if you take in the B2B spaces, which are more in the mid and small cap, there for right reasons their growth has been higher, and for last 4 to 8 quarters market has been waiting for the growth coming back in the large cap, but mid and small cap delivered good growth. My observation is large caps normally the growth is more linked to nominal GDP growth. So the nominal GDP growth has been lower in last couple of years. Larger companies being larger, they don't have much ability to outperform the nominal GDP growth because they are very large and they don't have optionality. Which can bring in the additional kicker to the earning growth per se. While mid and small cap auto, if you take a case of the auto ancillary, if the auto OEMs are not growing, they are exporting somewhere or they are doing non-auto businesses also. Well, that is not the case with auto OEMs, which
so
are the large cap.
they may have more levers to play if one segment is not working.
True, and that's where the large caps are more geared towards the nominal GDP. Now, coming back to the current context, if you see recently the nominal GDP growth has inched up. And actually it is getting helped by obviously the inflation as well. And historically what we have seen, whenever nominal GDP growth is good, then it reflects in the numbers. So if you see there is a price increase, and you have seen that the price increase, so obviously it will have an impact on volume growth, but overall revenue growth reported by the companies are correlated to the nominal GDP growth, and the large cap space being more levered on that. I would say that yes, there is a possibility that the large cap growth may be better than earlier, and if you couple this with the valuations which are being reasonable, there is a risk reward which is favorable in the large cap today. I'm not always saying that mid and small cap are not going to do well, but mid and small cap, for the growth, the valuations have reached certain level beyond which it is very difficult to stretch. So their growth is going to be higher, but valuations are also equally or more higher. While in case of large cap, because the growth was lacking, the valuations are reasonable. If growth comes back because of nominal GDP growth, because of crude falling, because of the measures taken by both the government as well as RBI and liquidity coming in the market. So the reasons can be any of these, because of which if the nominal GDP growth improves, there is a case that the risk reward may turn out to be better in the large cap. So that's where the large cap space comes to picture.
But do you think, like you mentioned, the nominal GDP point, do you think with nominal GDP also pulling up, FII also can find a way into the segment?
Definitely, and you raised the right point, that FII outflows, which has been there, which has been more so from
largely
the large
hurting
cap,
the large
and that also has hurt. Now with the rupee stability, with the actions taken by both government as well as the banker, central banker, there is comfort on that front. And if the nominal GDP growth improves, that is actually reflected in the credit growth. So if you see credit growth numbers are improving in the market. Broadly, the consumption numbers are reasonably resilient. The impact is not as bad as one would have feared during when the war started in Iran. So in that context, there is a case for the large cap.
Looking at large cap category, yes. Now coming specifically to Axis large cap fund, how do you think you have positioned the fund? Why do you think there is merit in looking at the fund?
Definitely. So in Axis large cap fund, if you see, we have sizable overweight on multiple sectors and sizable underweights also. Now if you just see what are the trends currently, nominal GDP growth improving. If the crude, which has fallen already, if it stays here, then in my judgment the beneficiaries would be those companies which are in the consumption space as well. So these companies will benefit both from the revenue growth because of the price increase, and we have to pick and choose, and we have picked and chosen the companies where the impact of the raw material increase on the margins would be minimal in that context, in the context of price increase also they have taken. So from that point of view, I think the fund, the way it is positioned, so one which I highlighted, that there is a credit growth improvement. Most of the banks and NBFCs have highlighted that the credit quality is good. So in that context, we have actually increased weight on the lenders side in the fund. So if you see last year versus last month end, there is a sizable improvement in the exposure to lenders in this. Secondly, overall exposure to the consumer part through hospitality, airline, hotels, hospitals, so multiple such segments, retail industry, so multiple such segment, there is exposure in this fund, and which is sizable in my opinion. And lastly, we also have a good exposure to the sector like healthcare and pharma. So there we have a sizable overweight exposure. So in my opinion, we have played a good conviction in this entire space, which may benefit if the crude oil prices continue to remain low, nominal GDP growth improves, as well as the credit growth along with the credit quality stays at this level.
And any sectors that you think you're not wanting to play in the large cap space
yes,
currently?
So if you notice that our exposure to utilities, our exposure to commodity as such, so these segments continue to be very, very low.
But commodities, not being exposed to commodity would have played counter to you in the last couple of months,
yes,
right? That also would be a reason for the drag in performance.
So when there has been a commodity rally, there obviously we didn't hold commodity as much in the portfolio, so it would have affected. But now since the commodities have corrected, I'm sure that that should be
now it will be the reverse of that. Sure. Exactly. So I think this has been very helpful, Shreyas. The most commonly asked questions in the webinars that we do for large cap funds has been on underperformance, and thank you for addressing it upfront. So we understand that the phase immediately post COVID, because up till COVID there was a good history of performance with the fund. It is actually the 2 years or 2 to 3 years kind after COVID when the performance took a major hit. After that, unfortunately, it coincided with a massive mid and small cap rally, and we have at Axis for the Axis large cap fund, we have primarily been in the large cap space, which is also B2C space, and that has not that sector rotation, style rotation was not favorable for the fund. But today at this juncture, looking at where the valuation is versus a mid and small cap, where the very important point that you raised, the large cap space is very correlated to the nominal GDP, and which was sub 10% so far in the last couple of years, which we anticipate will move up now. That correlated with, that will give an impetus to the large cap space, and hence the large cap fund and possibly the FII then looking at this segment.
So from a large cap perspective, in my opinion, the risk reward is good in the large cap space. One, because of the valuations being reasonable compared to pre-COVID. Other is because of the nominal GDP growth improving from the single digit to the double digit, helped by inflation. And mostly we have seen the high correlation of nominal GDP growth with the large cap earning. Thirdly, this space has multiple segments where you have already seen the improvement, like the credit growth, which has a high representation in the large cap space. If the crude falls and if it remains even at the current level of sub 80, that is again a good news for the B2C oriented segment, which actually got hurt because of the high inflation which was seen. So all in all, the risk reward definitely is good in the large cap space. As far as our fund is concerned, we are oriented towards these categories. If you see our overweights in these sectors, whether it is lenders, whether it is retail oriented companies or hospitality, airline, hotels, etc., including pharmaceutical space and healthcare. So there are multiple these segments where we are overweighting. So if this thesis of low crude oil prices and good credit growth, if it plays out, then I think that the fund is well positioned.
I think all these aspects build towards a case that says, investors can be patient in this category, can stay invested in the category, and also the Axis Large Cap Fund. Thank you so much, Shreyash. This has been most helpful. Thank you, investors, for staying tuned. Take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.